Hi, this is Dr. Bear, and today I'm going to take you through just a brief introduction to accounting, and we're going to explain what accounting is. Accounting is the language of business, and I like this quote by Harold Geenan, who is the former chairman of ITT. He stated, "To be good at business, you have to know the numbers cold." So basically what that means is if you don't know how to read financial statements, you can't really know your business. Accounting is the language of business because it is the way that a company captures and records the economic activity and how they communicate this information to the external and internal users. The users of the financial statements need this information in order to be able to make decisions. External users include investors, lenders, creditors, customers, and even governmental entities. The internal users are the managers and the employees of the business. There is also a process to accounting. The process of accounting is the planning, recording, analyzing, and interpreting of the financial information in the accounting system. There are different types of information that you can get from an accounting system. You get the operating information, which basically discusses how you track your cash, how you pay your bills, the types of cash that you've received for your sales, and changes in your financial records. And then you have financial information that communicates your financial position to banks and creditors and investors and those other external users that I mentioned previously. Then you have the managerial information, which is the internal information that is given to the managers and employees of the company for them to be able to make decisions on how to best run the company. Accounting is a dual entry system, and what that means is every time you enter a transaction into your accounting system, you are going to affect at least two different accounts within that accounting system. You all heard the terms debit and credit. So when you create a financial transaction, you have to have at least one debit and at least one credit. And those debits and credits are going to be to two different accounts. You can have more than one debit and one credit. You could have two debits and one credit, or three credits and one debit, or any number of combinations. We're going to talk more about the debits and credits and actually capturing the financial information and creating these transactions in later videos. And the accounting information we've already discussed previously. Now, who creates the rules for how accounting is created and entered into the accounting system? The Securities and Exchange Commission, the SEC, has primary responsibility for creating what is called the Generally Accepted Accounting Principles, or GAAP. We're going to see that in just a second on this slideshow. And the SEC, again, as I said, they have the primary responsibility for creating GAAP, but they have passed that responsibility down to the Financial Accounting Standards Board, the FASB. You may have heard that term before, or you may not have, but if you haven't, you will eventually if you're going into the field of accounting. So the FASB creates the standards, but the Securities and Exchange Commission has the authority to override anything the FASB does. They do not generally do that. Normally, they just go with whatever the FASB creates. But they are also more of the enforcement arm, the Securities and Exchange Commission is. So the FASB creates the standards, the Securities and Exchange Commission enforces those standards. But the SEC is really only concerned with public companies. And a public company, public corporation, is a corporation that sells stocks and bonds to external investors. So the Securities and Exchange Commission oversees that to make sure that these public corporations are recording and reporting their financial information following the guidelines that have been created in order to protect those investors. I'm not going to get into that right now because we'll discuss that more later. So as I just mentioned, the Generally Accepted Accounting Principles are created by the FASB. Then you also have international accounting reporting, financial reporting standards that are created by the International Accounting Standards Board. This is becoming more important because there's been an ongoing project for nearly 20 years now with the Securities and Exchange Commission for the United States to eventually adopt international financial reporting standards. Currently, in the U.S., we use U.S. GAAP. There are many other countries that use international financial reporting standards, and there are some differences between U.S. GAAP and IFRS. So we've been going through this process for, as I said, nearly 20 years to converge the two standards, which means we want to eliminate the differences. We want to eventually adopt international financial reporting standards so that we are reporting our financial information the same way that many other countries are reporting theirs. And it's because the world has become so global. Accounting has become global. Companies have become global. So it's becoming more of a need for us to be on the same standard as everybody else. Now, there are many principles and assumptions in the field of accounting that are part of the ideas behind the way this information is captured and reported. The first one is called the economic entity assumption. And what this means is that a business is separate and distinct from its owners and from other businesses. So if you are an owner of a business, you cannot commingle your personal finances with those business finances. And if you have multiple businesses that are not related to each other, you cannot commingle the finances of those individual businesses. Then we have the cost principle, which states that activity is recorded at its actual historical cost because cost is a reliable measure. So we're not capturing information in most instances based on fair market value. That's a different valuation from historical or actual cost. We'll be discussing that more in depth as we get into financial statements and the other videos that I'll be creating. Then we have the going concern assumption, which basically states that accountants take the assumption that an entity will remain in operation for the foreseeable future. The monetary unit assumption, basically the United States records transactions in dollars. During periods of inflation, the dollar might purchase less, but the accountants make the assumption that the dollar's purchasing power is going to be stable. So items on the financial statements are measured in terms of that monetary unit. The time period assumption, basically, accounting information is recorded and reported for a specific time period, and that time period is the company's fiscal year. Now, the fiscal year does not have to necessarily coincide with the calendar year. Most businesses, or I won't say most, many businesses do not have a January to December fiscal year. You might have a July to June fiscal year, or an April to March fiscal year, or some other, very year like that. But you're going to capture and record the information for each fiscal year of your company. You also may break that process down into months and quarters and semi-annual periods of time. But for the purposes of reporting the annual data, which is the most critical data that goes out to your investors and your creditors and your government entities and others, is that fiscal year. Okay, the next principle is the conservatism principle. Now, we've kind of gotten away from this, but you may hear this still in some talk as you go through the accounting profession. Conservatism basically states that you are going to record information in the most conservative way if the numbers are not known. The rule of thought nowadays is not so much about conservatism. It's about being as accurate and reliable as possible, but when accuracy and reliability comes into question, you still err on the side of being conservative. So basically what that means is you are going to err on understating revenues and overstating expenses, because you do not ever want to find yourself in a position where you have overinflated the valuation of your revenues or understated the valuation of your expenses, which might mislead investors or creditors or others in regards to making decisions about your company. All right, then there is the terms realization and recognition. And those are different. Realization is regards when you actually receive the money for a transaction or pay the money for a transaction. Whereas recognition is when do you recognize that information on your financial statements. That may or may not be at the same time. You may be recording things on your financial statements that have not yet been paid or not yet received. So realization and recognition are two different terminologies. The matching principle. The matching principle basically states you have to match your current activities with your current receipts. We'll be discussing this more in depth when we get into transactions reporting and financial reporting. So I'm not going to spend a lot of time going into great detail about it right now. Then next we have the consistency principle. So basically you have to maintain consistency in the way you report financial information. You cannot change your methodology, flip-flop back and forth. If you have a certain way of reporting something, unless you have a valid business reason for changing that methodology, you have to maintain consistency and report it the same way every time. And the last one I'm going to talk about is materiality. Materiality is whatever amount would cause a decision to change in the mind of an investor or a creditor or someone else that's looking at your financial information. So for instance, a $10,000 error might be very material for a small business, but it might not be for a very large multi-billion-dollar company. So when you're looking at the way information has been captured or estimated or reported on your financial statements, you always have this concept of materiality in the back of your mind. Is this something material that could cause someone else to change their mind about investing in our company or loaning money to our company? All right, I still have a goal of trying to keep this video as short as I can, so I'm just going to go through a couple more slides here. What you're going to get introduced to at the very beginning of an accounting class or beginning to learn how to capture financial information is the accounting equation. And the accounting equation basically states that assets are equal to liabilities plus equity. Equity can be stockholders' equity if you're a corporation, or it could just be owner's equity if you're a private business. And if you notice on my slide here, I've broken down the stockholders' equity into different components. What makes up stockholders' equity would be common stock. So this is investments that owners are making or investors are making into the company, and they're receiving common stock in return. The other thing that affects your equity is the revenues and expenses of the company. So as you're earning money and paying the expenditures of the company, it's going to have a direct effect on your equity. We'll talk more about this in later videos when we get into actually capturing information. Another way that you can state this equation is assets minus liabilities is equal to equity. That's a very important concept because assets are the economic resources that are available to the business. The assets are what the business is holding that has value, the assets that they own. The claims to those assets are in the form of liabilities. This is money you owe others. If you owe money to a lender or a creditor, or if you owe something to a customer, that's a liability. Then whatever's left over after all of your liabilities are satisfied is the equity that the owners can claim against the assets of the company. You must always satisfy the liabilities before owners can take any of the assets out of the company. Now, that does not mean if you're an owner that you can't withdraw money from the company. It just means if the company liquidates before owners can claim any of the value of what's left in that company, all of those debtors, those liabilities must be satisfied first. I want to talk briefly about careers in accounting. If you're interested in going into the field of accounting, there are very ways that you can go about getting involved in accounting. You can become an accountant. An accountant is a person who plans and summarizes and analyzes and interprets the accounting information. A public accounting firm is a business that sells their accounting services to the general public. Then you have private accountants. These are accountants that are employed by a single business. And there are different levels of what type of accounting you can do. Just like a doctor could become a pediatrician or a general surgeon or a brain surgeon or whatever, there are different levels of accountants as well. You could be an accountant that specializes in accounts payable, which is paying the liabilities of the company, or an accountant that specializes in accounts receivable, which is the money that the company is collecting from its customers. Or you might be a general ledger accountant that really focuses on the entire operation of the accounting system. Or you could be a forensic accountant. Maybe you're someone who likes to go in and analyze where a fraud has been committed and dig into it and find out, how the fraud was committed and how deep it went. So those are just some ideas of different levels of accounting that you could get involved in if you're interested. A bookkeeper is someone who does just general accounting work. They can summarize and analyze some of the accounting information, but they're more involved in just capturing it and recording it into the system, not making decisions on what they're doing. They're just capturing that information and reporting it to someone else. An accounting clerk is a person that sorts and files accounting information. Then you have a general office clerk as a person who just kind of takes care of general office tasks, including some of the accounting tasks. If you're interested in becoming an accountant, you might want to become a certified public accountant, and that involves taking a pretty extensive exam and passing the different parts of that exam to be able to call yourself a CPA. It's a certification that generally you have to have a little bit more than a bachelor's degree in most states. The rules are different in each state on what is required for someone to actually sit for the CPA exam, but generally it's somewhere between the bachelor's and master's degree. You have to have about 150 hours of college in most instances in order to be able to even qualify to sit for the CPA exam. And there's other qualifications too that go along with that. You either have to work in the field of accounting or have worked under a CPA for a certain amount of time. You would just have to check with what the rules are for your state. There is the AICPA, which is the American Institute of Certified Public Accountants, that you can join as a student. But if you become a CPA, you're required to have a membership with the AICPA. And there's other professional organizations, usually even at the state or local level where you live, that you could become involved in if you're interested. Now, what are the skills needed to become an accountant? Basically, there's only two. The first one is communication. You have to have some level of skill in being able to communicate information to others. And the last one is ethics. You've got to be a person that has good ethics. Ethics is what you do when nobody else is looking. Ethics is extremely important if you're working in the field of accounting, because you're handling the money that belongs to other people. And there are, some sometimes even when doing something legal may not mean you're doing something ethical. So ethics, it does involve legalities to a certain extent, but just because something is legal doesn't mean it's ethical. There's a lot of things that can cause unethical behavior. When a company really focuses more on profits, they can encourage people to become unethical to meet those profit targets. People that become, have misplaced loyalties to the company, or if they're seeking to personally advance themselves, or if they have an expectation they're not going to get caught because there's not good internal controls. We're going to talk a lot about internal controls as well. Or sometimes the business environment itself is unethical. If any of you are familiar with the case of Enron, that was an example of a very unethical business environment where the tone of the ethics was set at the top, and it was set as an environment that fueled and encouraged fraud. So anyway, that's the end of my slideshow. I've taken up more time than I wanted to with this, but hopefully this is just a good basis of understanding of what the field of accounting is before we get into the meat of it. So I hope you join me and come back and subscribe to this channel for the videos that I will be posting and the new ones as I create them, because I'm going to delve into a lot of topics related to understanding accounting and capturing financial information, how it's recorded, and even how you can use it in your personal life.